What are we doing today, folks?
Right.
Good. It's good to have the Excel assignment monkey off our backs now. Yeah, it's been done and submitted. So all we got left is got the professional interaction, which many of you have already done. Great. And then we got exam coming up in a little over a week and a half, and then get to enjoy Thanksgiving break. Everybody looking forward to Thanksgiving break? Yeah, it's gonna be nice. So I'll do updates with what's going on for the rest of the semester. I'll do that probably early next week. I'm gonna basically get started now because this is a short homework assignment, and so it's not gonna take us entire class period. And if I'm not sure, I'm sure everybody would be happy if I give you a few minutes off on a Friday, you know. I know if I give you a few minutes off on a Monday, that's just too much, you know, but a few minutes off on a Friday, yeah. Let's go ahead and get started then. So which of the following procedures would most likely be considered a weakness in the entity's internal control over payroll? So let's just go through these and kind of identify what we think about these. Voucher for the amount of payrolls prepared in the general accounting department based on the payroll department's payroll summary. So what do y'all think about that? Seems fine to me. Seems like a good routine that probably should be followed and doesn't really explicitly identify any control weaknesses. So I'm okay with A, all right. Payroll checks are prepared by the payroll department and signed by the treasurer. So this is something we haven't really talked about, but we already know that the preparation occurs at the payroll department because payroll is what type of function? Reporting, okay. If we're talking about the treasurer, we're probably talking about somebody who's signing that, which signing sounds like what kind of function in that regard? An authorization function. So we have a separation of responsibilities there, which seems appropriate, okay? So I think B is fine. The employee distributes the payroll checks, returns unclaimed payroll checks to the payroll department. All right, so they got payroll checks. Payroll checks represent an asset for the organization. Okay, so the person who distributes them probably has what function? Okay, so when he's done, he returns anything that's not claimed, any payroll checks that haven't been claimed, returns those to the payroll department. So he's transferring custody to the recording function. Do we see a problem with that? Yeah. Violation of segregation duties in C. So that's probably our answer, but let's just go ahead and look at D. Human Resource Department sends employee termination notices to the payroll department. That's just transfer of information from one department to another. It seems like a good control. So C, we had to do a little bit of digging, but C seems to make the most sense in this context. 1218. The purpose of segregating a duty of hire personnel, one of my favorite topics, segregation of duties. Yeah, there we go. Hiring personnel and distributing payroll checks to separate what? So we talked about one of these. Distributing payroll checks is going to be a custody function. Okay. What about hiring personnel? What do we establish that was going to be primarily? A hire authorization task. Okay. So hiring, we're basically saying we're authorizing this person to work for the company and we're authorizing pay for that individual. So authorization of transactions for the custody related assets, does C sound like a reasonable answer in this situation? Yes, and it is the correct answer. By the way, if you could answer the other ones, those were a little bit less intuitive simply because we're talking about segregation duties. We're talking about CAR. You will never forget those letters, by the way. You may forget what they stand for, but you'll remember Dr. Barr and something about CAR. Also, just as a reminder, what I told you from AIS, if you ever use ARC in my presence, I will deny your existence, okay? It is CAR, not ARC, okay? I know that seems really extreme, but I'm really passionate about this whole thing. Okay, 1221. Which of the following audit tests would most likely be used to test for the occurrence assertion for payroll transactions? So occurrence means what? What is the longhand for occurrence? Like this is shorthand, but what assertion are we talking about? Existence occurrence, okay? So it's used interchangeably. If you see one word, you can properly apply it to the other. So what direction do we move when we're talking about existence occurrence? We move into top to bottom, bottom to top. Top to bottom, yes, okay. So this one, if assume it's used correctly, C says vouching a sample of payroll checks from the payroll register to the approved timesheet summary in the master employee list to verify validity. What do y'all think about that? Is that proper direction? It says vouch, okay, it says vouch. It says vouch, but is it actually vouching? So we're talking about the payroll register. So that's where everything's recorded. Okay. So we're looking at something that's recorded to make sure that it properly exists. So we're looking at the source document. So we're going from record to source. Looks like the correct answer to me. Okay. Interesting story about this. All right. You know, you were using a fairly new edition of the book, the 2025 Evergreen edition. This used to say trace in previous editions of the book. You don't believe me? Okay. You don't believe me. All right. Here we go. There's my answer sheet, which is based on the other one. So let's see. You can actually see the word trace up there. You can also see that I wrote the word R next to it because I was frustrated by it. All right. So yeah, That's something you need to note. They actually corrected that this time. So yeah, vouching is given away. So this should have been an easier answer for you because you didn't need to actually determine it too much. Now, the argument for asking this question in the previous years was the same reason that I've used for this semester as well. As I said, not only do you need to know what the directions apply, but you have to make sure the directions are valid, that tracing is moving from bottom to top and vouching is moving from top to bottom, which in both of these situations they are, which makes this an easy question. But it doesn't negate the fact that you have to do the work here. Okay, you have to do the work. And meanwhile, I'm going to have lived all those years where they said tracing and just been frustrated. Okay, so yeah. What's that?
No longer.
No longer though. They've improved that. Apparently my massive amount of emails saying fix this, they finally got it fixed after 3 different editions. Okay. This literally has existed in previous editions, and their justification is that sometimes people use trace when they mean vouch. Okay. I said we should be better than that. We're the ones who are supposed to be teaching this properly. We need to teach the other generations the difference between tracing and vouching. It's now imperative on you all to go out in the real world and tell everybody the message. I couldn't say that with a straight face. All right. Speaking of wasting time, all right. Auditors most likely to perform substantive tests of payroll transactions and test the details of payroll account balances when what? Okay, so cutoff tests indicate a substantial amount of accrued payroll expense. So what do we know about cutoff tests? What phase of the audit does take place? During substantive procedures. So we're already in substantive procedures. We could adapt the scope a little bit, but that's less likely to result in more substantive testing. Level of control risk relative to a payroll transaction is set at low. I do think we need to consider control risk, but what would cause an increased work in substantive procedures? Would it be control risk being low or control risk being high? High. If control risk is high, that's when we have to increase the work in our substantive procedures. So B can't be it. Substantive analytical procedures indicate unusual fluctuations in recurring payroll entries. Do substantive analytical procedures occur before substantive tested details? Yes, they do. Okay. So if you did some substantive analytical procedures and say, this looks weird, would you want to say, I probably should investigate this further during my test of details? Yes. And that's what this is trying to imply, saying you've identified a problem, you need to investigate it further. So C is our answer, but let's go with D. Accrued payroll expense consists primarily of unpaid commissions. Is that a problem? No, it just means they haven't been paid yet. Okay, where are you going to accrue these unpaid commissions? Probably an accrued payroll expense. Okay, probably in an accrued liability, or sorry, accrued expense account. Yeah, sorry, accrued item. All right, let's move on to chapter 13. So 1315, which of the following control activities would be most likely to assist in reducing the control risk related to the occurrence of inventory transactions? Again, we see occurrence, we're thinking existence occurrence. Get in the habit of that vernacular when you see one term. Same holds true for VAA. You may see accuracy, you may see valuation, you may occasionally even see allocation, but you can just think about it in the same context as all 3. By the way, when I'm on the exam, I will very occasionally do that, not usually. Usually I will default towards the entire term, but I think on the 3rd exam, I may get a little bit more lax on that just to get you in the habit of thinking about it. So make sure that you keep that in mind. If you see occurrence, existence occurrence, if you see allocation or if you see evaluation or accuracy, you think in BAA, the full term itself. All right. So which is going to reduce the control risk with related to the occurrence of inventory transactions? So the inventory manager does not have the ability to record inventory transactions. So if you're an inventory manager, you're probably responsible for. It depends. It really depends on the definition. It depends on whether or not you're on the warehouse floor, but we're talking about either an authorization or a custody function. Probably an authorization function. Although there's some argument for that. It could be either authorization or custody. Regardless of which, when we talk about the next area, recording of inventory transactions, is that a problem? Yeah, if somebody has the ability to gain custody of the inventory or the authorization of inventory, and they can also record, they could steal that inventory or they could misappropriate that inventory. So the split of this, the separation of these responsibilities, is that a good control? Yeah, it's a strong control in this area. So we think A is probably our answer, but let's go through the rest. Summary of the receiving reports is independently compared to the inventory status report. Okay, so that's probably not a bad function, but is that going to reduce the risk of reducing the control risk related to occurrence? Probably not. That's more a VAA task. That's more a VAA check. Okay. What about inventory is periodically reviewed for slower moving or obsolete items, which may require a write down? Is that a good control? Yeah, I think that's probably a very good control and check on that. Is it related to existence occurrence? So you've got a whole bunch of blackberries sitting on the shelf, and you're just like saying, do those blackberries exist? Well, they're right there. Okay. So we're not really concerned about existence occurrence. What are we concerned about? It's another valuation issue again, because again, if it's obsolete, it's unlikely that they're going to be able to recognize the value that they've allocated for that item. So that's another VAA issue. Subsidiary ledgers are periodically reconciled with inventory control accounts. This is another VAA item. So pretty easy distinction there if we're talking about existence occurrence and the separation of VAA. By the way, this is something that came up in AIS and something I want to remind you of. If you're planning on sitting for a certification exam, doesn't have to be the CPA exam, though that's the one I usually default to in this course. If you're planning on sitting for any certification exam, be very, very aware that you need to be able to identify most likely questions. We're looking at statements that are patently correct in this situation. All 4 statements are patently good controls, okay? We're talking about which one specifically relates to the existence occurrence assertion. So that's something that you're going to have to become very, very acclimated to in the future. I've already given you some exposure to it, but you're going to see a lot more of it, particularly if you're planning on sitting for an advanced certification exam, which I assume a lot of people in this room are. All right. 317, independent internal verification inventory. So proper segregation of duties occurs when employees who do what? So let's go ahead and do our standard. Let's go through each of the answers. Employees who issue raw materials obtain materials requisition for each issue and prepare daily totals of materials issued. Okay, so this one's a little bit dicey because we look at it, we say that we obtain materials requisition. Are they actually obtaining the custody for materials? Are they actually acquiring the materials themselves, or are they recording the materials records? So they're getting the materials records and they're preparing daily totals on those. So this is kind of a series of recording functions, which doesn't appear to violate segregation of duties. Compare records of good on hand when, or sorry, does it appear to be a separation of responsibilities? So it's fine, but it's not really separating responsibilities. Compare records of good on hand as physical quantities do not maintain the records or have custody of the inventory. All right, so we're looking recording listed here, custody listed here, and these 2 responsibilities should be separated out for those who are comparing records of good on hand. So what would that be? Who would take the responsibility for looking at records of good on hand to make sure it's correct? This sounds like a supervision or a review of the recording process, which I would kind of loosely assign as an authorization responsibility. So the people who are kind of approving the records are not the ones who are actually making the records or the ones who have custody of inventory. So we're separating out custody, authorization, recording. Does that sound like proper segregation of duties? Hope everybody's emphatically yes, because that was the end I was trying to get to. It's like, yes, CAR are separated. That's going to be segregation duties. So this is our answer, but let's go through the rest. Obtain receipts for transfer of completed work to finished goods, prepare a completed production report. Okay. So again, series of recording functions, good practice, but not necessarily a segregation of responsibilities occurring here. Are independent of issuing production orders and update records from completing job cost sheets and the production costs on a timely basis. Okay, so basically people who are doing recording functions are still not doing other recording functions. I would argue that this is probably a pseudo segregation of responsibilities, but it's not nearly as clear as B right here. So again, this is more about redundant recording functions rather than being separation of different responsibility areas. So interesting analysis here. 1320. An entity maintains perpetual inventory records in both quantities and dollars. If the level of control risk were set at high, an auditor would probably do what? Okay. So would they insist the entity performs physical accounts of inventory several times during the year? Boy, that sure sounds like a good answer, doesn't it? Everybody's kind of like, yeah. Well, I mean, if we are a little bit low uncertainty, because if we say control risk is set high, counting several times is going to be a valid check on this. It's going to be something that if they do over and over again, then we're going to be really, really certain that the inventory is correct. So let me ask you this. If we're trying to make sure the inventory balance at the end of the period is correct, does it matter how many times we count during the year? No, not really. We're only concerned about what the balance is at one point in time, and that's year end. So counting it multiple times will verify that it's correct at that point in time, but that's really irrelevant to whether it's correct at year end. All right. This is a trick one. This was a tricky one. That first one, it sure looks good, but if you think about it logically, it doesn't make sense. Apply gross profit test to ascertain the reasonableness of physical counts. That's probably a good test, but it's not going to be something that we would focus on. Increase the extent of tester controls of the inventory management process. So if we've already established control risk is set at high, we've already conducted tester controls. So it doesn't really make sense that we would increase the extent of tester controls because we've already established control risk at high. Controls are not to be relied upon. So that's something that we would already know. So we request the entity schedule a physical inventory count at the end of the year. Does that make sense? How much assurance do we get into year-end activity versus interim activity? More or less? More. So we're increasing our assurance. Would that make sense if we're saying control risk is set at high, that we'd want to increase the extent of assurance that we gain through substantive testing? Yes. Okay. That's the logical conclusion for this one. So D is the one that makes the most sense in this context. 1322, when auditing merchandise inventory at year-end, auditor performs a purchase cutoff test to obtain all evidence that, all right, so all goods purchased before year-end are received before the physical inventory count. I think that's a logic. That's a reasonable approach. Say, okay, we ordered from you December 31st. You are going to have to ship right now. Okay. I know you're in California, but you're gonna have to ship it within the next 7 hours to get here. Yeah, that sounds about right. So yeah, unless their name is Walmart, we don't get away with that. Okay. Walmart gets whatever they want. And apparently Tesla too. Yeah, so I'm sorry, I'm making light of the whole news blitz about Elon Musk's salary. So anyway, yeah, so that's not going to make sense. No goods held on consignment for customers are included in the inventory balance. Okay, that's probably a good thing to check, but does that test cutoff? No, it tests rights and obligations. Goods observed to the physical count are pledged or sold. This is another good thing to check, but this is also rights and obligations. All goods owed at year-end are included in the inventory balance. That's probably our cutoff test right there. That's our cutoff test right there. Probably because it's the only answer that's left to be correct, but it makes sense because that's exactly how we would think about cutoff. All right. 1323, inquiries of warehouse personnel concerning possibly obsolete or slow-moving inventory items provide assurance about management assertion of what? So we're talking about obsolete or slow-moving inventory items. We've already established this earlier. We talked about it a little while ago in a previous question. What assertion are we focused on in this? Yeah, okay. Obsolete and slow-moving items, because the amount that's probably recorded on the books is not what the realizable value is. All right, moving on. We've got a couple problems here. So 1332. All right, so I want to look at E real quick, okay? E basically says the assertion is completeness and accuracy and valuation of a presentation and disclosure. This is one of those ones I was talking about that somebody was at the editing office and like, I don't know what any assertions are, so I'm just going to put all of them on there, and hopefully I'm going to be correct about one of them. All right. We're probably going to be focused on completeness in this particular area, but yeah, it's I shouldn't say that. I think it's actually more presentation and disclosure. So I said completeness and I was wrong. So presentation disclosure is probably our primary one, which will make things a little bit easier. But yeah, this is another one that I've complained verbally about to McGraw-Hill, and I've said, could you please fix this? And they have yet to fix. Now they fixed some of the problems, which is good news. That's progress. Any progress is progress, guys. All right. So let's go ahead and go through this. Ensure the entity has legal title to the inventory. Ensure the entity has legal title of inventory. So what would be a good audit procedure to actually check this? Probably some sort of documentation that actually implies legal title. All right. Now this note, this does not need to be the actual title itself. Okay. We can actually infer this from other documentation that's present, but which one of these is going to be the most relevant inference of documentation with respect to rights and obligations? What about 6? Review loan agreements and board of directors meeting minutes. It seems like a really broad one, but I think this is the most appropriate one given the ones we list. So A is going to be 6. Ensure the recorded inventory quantities include all products in hand, which is going to be our test for completeness. All right, so we're looking for something that's going to be representative completeness. Now, again, what direction do we move for completeness? Bottom to top, okay? Bottom to top. So we're looking for something that's bottom to top testing, okay? So let's look at 3. Select a sample of items during the physical inventory count and determine they've been included on the count sheets. What does that sound like to you guys? What is that concept called? That's floor to sheet. Floor to sheet. Sheet to floor is the other direction, but yeah, you're on the right track. So floor to sheet, okay? Is floor to sheet completeness? Yeah, it is, okay? So we can actually accept 3 as our answer. All right. Verify that inventory has been reduced when appropriate to replacement cost or net realizable value. So we got valuation. I love how we have accuracy down here, okay? So this is kind of interesting. So when appropriate to realizable cost or value. So what do we need to know if we want to make sure that we are testing this inventory for the proper realizable value? First thing to establish is what is the realizable value, okay? What is the amount that we can realize on this? So we probably need some sort of external reference. Is there an answer that actually has an external reference to realizable value? Yeah, the vendor price list on part 1, okay? Examine the current vendor price list. Now, D says, verify the cost of inventory has been properly determined, the accuracy. I will answer in this one that I think there's 2 possible correct answers that kind of cover a little bit. Both of them are incomplete, but used together, I think that would be joint. Now, the answer the book gives is they say 4. Select a sample of recorded items, example supporting vendor invoices and contracts. And I think that's the most direct test. And I think that you would not be hard pressed to go wrong. That being said, if we want to do it at a more general level with the financial statements as a whole and not look at individual transactions, we could also go back to one and examine the current vendor price list. The problem with doing one by itself is that if the vendors have changed prices recently, then it would not give a proper basis for comparison. So I think you can do both 1 and 4 together and give a much better coverage, but 1 and 4 individually would not be full coverage by themselves. All right, and then verify the major categories of inventory and their base evaluation are adequately reported in the financial statements. So blah, 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 presentation and disclosure. So if we're looking at the financial statements, we probably want to look at the financial statements, okay? So review the drafts of the financial statements is going to be our answer here. All right, last one, but this is a fun one. So here's what we're going to do is I'm going to read through this narrative and I'm going to provide some pauses on some important points that I think are very, very relevant. And then we're going to talk about the things, particularly the pauses that I made, and see if there were any issues that we could identify. Okay. Ando Company, a diversified manufacturer, has 6 divisions that operate through the United States and Puerto Rico. Ando has historically allowed its divisions to operate autonomously. Okay. Ando does not have an internal audit department, and corporate intervention only occurs when planned results were not obtained. Ando has a policy of hiring competent people. Management is fairly conservative in terms of accounting principles and practices, but employee compensation depends in a large part on performance. Now, we've talked about fraud risk, okay? Can we say that this represents one of the fraud risk factors that we talked about back in chapter 4? Sounds like an incentive for pressure to me, okay? So there's a possibility fraud may occur, and in fact, we're going to find out fraud has occurred. All right. So this is one of those ones that I've done it a few times in this course. I'm reading through this and I'm just kind of like, this is a beautiful fraud. Well done. Well done. JP Kumar is my personal hero if I wanted to be evil. So it's like watching Star Wars and wanting to be Darth Vader. Yeah. So yeah. JP Kumar is the general manager of the appliance division that produces a variety of appliances. Kumar has been able to improve profitability of the division each of the prior 5 years. Pretty impressive, right? Much of the improvement came through cost cutting, including a substantial reduction in control activities over inventory. So yeah, remember how we say controls need to be in place in order to be effective and address those risks? He said, risks are overrated. I'm going to cut the controls. All right. So recently, a new competitor has entered the market and offered a substantial price discount in an effort to grab market share. Does that represent a risk to you guys? Yeah. So it's probably important that they have controls to address the risks. Oh, wait. Okay. Yeah, the controls have been cut. Kumar is concerned because if profitability is not maintained, his bonus will be reduced. All right, so we don't want JP to lose his bonus. So what is he going to do? He's going to decide the easiest way to make the appliance division profitable is to improve the performance of the organization by making sure they become a leader in the industry and making sure that they do everything they could to compete with this new entrant and do everything in a honest and diligent way. I stopped reading. That's basically what the answer is, right? No, it's commit fraud, okay? Through manipulating inventory, which is the largest asset on the books. Kumar found that by increasing inventory 4%, income being increased by 8%. Now, again, we talked about this already, but why does increasing ending inventory increase income? So we increase ending inventory and we put that into our equation. So that's the base equation, beginning plus additions minus ending equals subtractions, which subtractions in this case is cost of goods sold. Okay, so beginning stays the same, the additions or the purchases stay the same. You increase the thing that's subtracted, which is going to be the ending inventory, which is a negative amount, okay? So if a negative gets larger, what happens to the result? It gets smaller, okay? So the result, cost of goods sold, gets smaller. So by increasing ending inventory, cost of goods sold is decreased. By decreasing cost of goods sold, what happens to the net income? Goes up. That's basically what's being described here in not so many words, which goes back to the 221. By the way, I don't think anybody in this classroom took 221 with me. I could be wrong. I did teach like one summer course, but I was big on this thing called the base equation, which is beginning plus addition minus subtractions equals ending. Okay. And I use that a lot. That's what I was using when I said base equation. You can actually rearrange it for cost of goods sold as BAES. Okay. Beginning plus additions minus ending equals subtractions, because subtractions is the cost of goods sold. But if you increase the ending result, that's a negative number. So that decreases the result. And that's how I came out to that, inferred that, whatever. All right. With the weakness in inventory control, he felt it was easy to overstate inventory. Isn't that great self-fulfilling prophecy? He cuts controls to save on cost, and now these controls that he's cut are allowing him to get away with this fraud. I mean, that's just working smarter, not harder, folks. Okay. If you're going to commit a fraud, make sure you get rid of the controls first. Okay. And doing it as a cost cutting measure. All right. What did you learn in auditing today? I learned how to commit fraud more effectively by cutting controls. Employees using the goods, employees using the goods count sheets, count using the goods, count the goods using the count sheets, and Kumar was able to add 2 fictitious seats during the physical inventory, even though the auditors were present and observing the inventory. Now, we talked about this. Auditors maintain control of the count sheets, and basically Kumar came in and said, hey, I forgot to add this in, throw that in there, and told the count workers, which auditors knew nothing about apparently. So auditors did not do their job very well there. A significant amount of inventory was stored in the racks filled in the warehouse. Because of the heightened difficulty of test counting them, Kumar was able to count an overstatement of inventory in the upper racks. All right, guys, we're going to have serious talk here. If you have to do an inventory count and you have to climb to the top of a rack, I don't feel any pity for you whatsoever. Get to up there and do the counts, okay? If I'm going to climb to the top of a 100-foot chemical tower to do an inventory in the middle of January while wearing a coat and getting the wind blown over and risking my life, you can at least climb to the top of a rack and count, make sure that you get all the count of the inventory. All right. You're much younger and much more able than I am. There's no excuses, no excuses. All right. At least until the point that something bad happens, you get into an accident and say, this was Dr. Barnes' fault. He told me I had to climb up there. So, all right. Let's just put it this way. The auditor should make sure that the inventory count is thorough. Okay. And the auditor did not do a very good job of that. Did not do a very good job of that. Auditors, sorry, my bad. After the count was completed, Kumar added four additional count sheets that totaled added $950,000 or 8.6% to the stated inventory. Kumar notified the auditors of the omission of the sheets and convinced them they represented overlooked legitimate inventory. How do you feel about this if you're the auditor in this situation? If we're auditors and just kind of like, okay, this guy gets a bonus based on inventory. He's trying to increase the base amount of inventory because he's got a vested interest to do so. This seems like it probably could be a fraud. So we probably need to be very, very thorough in making sure that this is legitimate inventory. How are we going to do that? Well, according to this, the auditor traced the items in the sheet to the purchase inventory to verify their existence. Is that what they did? That's what they did. Was that an effective test? Is guess more question. No. They said trace. Okay. What does trace test? Completeness. They definitely recorded it. They're recording that inventory. That's what JP Kumar is doing. But is that what we're concerned about? We're concerned about whether this $950,000 is legit. They did not do the job they said they did. They didn't verify existence. They verified completeness, which is a completely, totally irrelevant assertion in the situation because we know it's been recorded. What we're concerned about is, can we find that inventory anywhere? And if we just gone and tried to find the inventory that he had in the count sheets, we'd say, wait a minute. Even though he said it's on the upper racks, I actually climbed up here this time and found it's not here. Okay. So that was a very, very bad step by the auditor. They also did not notify management about the added sheets. In addition, Kumar altered other count sheets before sending them to the auditors, changing unit designations. For example, 6 motor mounts became 6 motors, raising counts, adding fictitious line items to completed count sheets. These other fictitious changes added an additional $375,000 to the related inventory. None of them was detected by the auditors. Okay, so that kind of leads us to some questions. Okay. These probably should be pretty easy after my little ranting about this, but let's just go ahead and do for posterity. What audit procedures did the audit apparently not follow that would have detected Kumar's fraudulent increase in inventory? So I think the very basic one that we need to start with is we need to identify the lax approach to the auditor during the inventory count. Now, if we go back and we look at what was said during the inventory count, one of the primary issues is that there has to be maintained control of the count sheets by the auditor at all times. Kumar added 6 different sheets at varying points, 2 during the count and then 4 after the count. He also managed to manipulate the information in the count sheet. Now, this is probably a foregone conclusion, but let's ask the question anyway. Did the auditors do an effective job of maintaining the count sheets in this context? No. All right. So now, is it possible that you could actually have a client that makes mistakes like this and they're legitimate oversights? Certainly, it's possible that's the case. Do we still have a responsibility as auditors to make sure all this is legitimate? Yes. And we talked a little bit about what was going on. Some of the counts was just sloppy. Some of the work was just not well done. The big one that really, really infuriates me is the one where he added the $950,000 to the count. And the auditor said, we're going to test existence, but we're going to move in the opposite direction to test existence. You can't test existence by starting with what was recorded, or by finishing with what was recorded. Okay, because remember, the direction is really, really important. So they didn't validate. There's also some other things, some other minor oversights that we can talk about. So first of all, this should have been a very, very key observation for the auditors early on. Say, man, this guy's just butchered controls. The controls here are just minimal. This is going to have to increase the scope of our substantive procedures pretty substantially, because there's basically no coverage of risk in this organization. And they've just encountered a massive new inherent risk with the entrance of a new competitor. So this should have necessitated more controls rather than fewer controls. The final one that I think we want to note is going to be management awareness. We already know that the corporate management is not very engaged in this organization. And so they only react to things when they're brought to their attention. What would be a good party to bring things to their attention when suspicious behavior comes up? Could it be the external auditor? Yes, we do know we have a reporting responsibility, not just to the audit committee or in governance, but also to management if the issues arise. The management should have been very aware that controls were just getting completely and totally sacrificed to this organization in order to maintain profitability. So yeah, what implications will there be for an auditor failure to detect material fraud as described here? So we've already talked about auditor responsibility for fraud is if it has a direct and material effect on the financial statements. That's kind of the idea of illegal acts, okay? So we have to design our procedures in order to be able to detect fraud that has a direct and material effect on the financial statements. Based on the context of the information here, did the auditor fail in that regard? So is this different than saying, all right, we've got an employee who basically stole a basketball from the warehouse? Would the auditor be responsible for detecting fraud of that type? Probably not. It's not a direct or effective, definitely not material. Compared to this one, can we say that this was a direct and material effect? So our procedure should have been very, very aware of this, and we should have definitely been able to identify it. I'm taking the role of the auditor now, taking the responsibility on me. All right. So auditors should have definitely been able to identify the audit or the fraud in this particular context because of our criteria for the direct and material effect on financials. And then what responsibility do auditors have to discuss their concerns with audit committee? So you actually do the testing here and you note so many problems, and this just goes beyond the scope of the fraud. Obviously, the fraud should have been detected, but what are some other big issues that should have been conveyed to the audit committee? That there were, what's that? The controls are a very big one. The controls are a very big identification, and much more than this case, I think, even emphasizes. Because as we've already established, we do need to have controls in response to risks. And we've seen increasing risks going over time. So there need to be more controls, not less controls. But JP Kumar has basically said, not only will this allow me to achieve my bonuses in the short term, but in the long term, when I need to commit fraud, there will be no controls in place to address this particular problem. So the auditors not only failed in the current period, but they probably failed in previous periods by not making aware that this incurred a substantial risk for the future. Okay. I would say that if this was a client that we were doing full controls testing on of internal controls or financial reporting, this would be an area where I'd say this is a significant deficiency. If left unchecked, we're going to have a disaster scenario where he's basically going to be able to completely and totally bypass all controls that exist. And we're not going to be able to do a darn thing about it, especially since we're not willing to climb on top of those racks. So always be willing to climb the ladder, okay? Unless for some reason the ladder is really wobbly and shaky, and then say, Dr. Barnes, I'm not going to pay attention to. All right, have a good weekend. To see you all on Monday.